We do hope that everyone is still remaining safe and healthy as things are starting to open back up and things kind of are getting back to somewhat of a normal. So there's a lot that we can talk about in regards to workers' compensation insurance, especially with the current state of things. Of course, there's probably more questions and concerns people have. Being that we have you for about an hour today, we're going to focus specifically on the workers' comp mod and ways to understand it as well as controlling it. So to talk a little bit about my personal experience, when I started working in insurance, I focused primarily on the personal side. So I would always hear and talk with others a lot about commercial insurance, specifically workers' comp, and hear about this mod. I would hear things like, wow, your mod's really high. That's a really good mod. What's your mod and what are you doing to control it? And I kept thinking to myself, well, what exactly is this and why is it so important? So of course, 12 years later, I of course understand and for experience modification factor. I know that it is one of the major rating factors that go into your premium. The others being the class of business that your employees fall under, the rate that's associated with that class, and then of course your payroll. So what we have found is that a lot of times the mod is oversimplified. The assumption is that it's very highly regulated by the state rating bureau, so there's really not much wiggle room and not much that you can do to control it. The reality is that out of all of the rating factors that I just spoke about, it is the one that you do have the most control over. So I'm gonna, just getting the PowerPoint back on track. Okay, so I'm just gonna go through the agenda for today. We're gonna talk about the mod, just explain what it is, how it functions, and how it's calculated. Then talk about the mod in action and go over some more specific scenarios to help explain it. And then of course, the mod mitigated. So we're gonna try to give you some tools and some resources to help you to control it and maybe even positively affect it. So who are your speakers today? You have me, of course, Diana Pursell. I'm a risk advisor with Borden Perlman. As I mentioned, I've been in the insurance industry for 12 years. My role right now with Borden Perlman is a risk manager for the commercial and business insurance. And Doug, if you don't mind, just to pop in and just give a little bit of experience about your background.
Sure. My name is Doug Coleman. I'm Executive Vice President with Borden Perlman. I've been in this industry in some fashion or another for about 20 years, and I've grown to become very passionate about using experience modification factors as a tool to save clients in their total cost of risk and also build strategies around. So I look forward to sharing what I know with you today.
Thank you. And I'm sorry, a couple of housekeeping things before we jump in. So we are recording this webinar, so we'll be able to share that afterwards. We are also going to be sharing the PowerPoint because there are a lot of good resources in here that you can use or you can use with your broker to help with your experience modification. And hopefully by the end of this, you won't be sick of hearing the word mod. So I'm going to talk a little bit about what a mod is and how it functions. So basically it was designed by the state labor departments to really put an onus on the employer and incentivize the employer to really operate safe operations. And of course, in turn, reduce workplace injuries. The way it does this, it's going to reward better than average loss experience with a credit or a reduction in premium, and then penalize on the other end worse than average performance with a debit or an increase in premium. So not every employer is subject to experience mod rating. It's usually based on the work comp premium size over a specified experience period, and this can vary from state to state. So what I can tell you is that for Pennsylvania, the experience rating would apply for any premiums over $10,000 over a 3-year experience period. And then in New Jersey, it is a premium over $6,000 over a 3-year experience period. So the basic mod formula is what you see before you. And in essence, what it is, it's calculated by comparing your organization's claims history for a period which begins 4 years prior to your renewal date, and then of course excludes the current policy period. And it compares that to an organization like yours. So like yours in the matter of payroll size, as well as the type of industry. So as a point of reference, the baseline mod that you'll see is a 1.0. So what that means is that the frequency and severity of your claims equal what they should have been or what the expected loss is. And at that point, there would be no debit or credit applied. And this is actually a really good illustration of how a mod functions and affects the premium. So you'll see on the one side, the employer has a mod of a 0.75. So what that means is during that rating period, they had a better than average claims experience. So you'll see they're being rewarded by a $25,000 premium credit versus the flip side where they had a mod of a 1.25. So that means that year they had or during that rating period, they had worse than average loss experience. So of course, unfortunately, then there would be a $25,000 or 25% more penalty because of that. So now that we understand what a mod is, how it's calculated and function, it's really important to understand the timeline from when data gets reported to the state rating bureaus, and then in turn calculates your mod for that upcoming renewal. So there's two important dates that you should to look to. The first is called a unit stat date. And this is 6 months, this date is 6 months prior to your renewal. And at this point, all incurred losses and payrolls realized in your rating period are valued as of this date. And this is what in turn is reported to the state's rating bureau for the mod calculations. It's really important to make sure that all your information in terms of loss data as well as payroll is accurate before this point, because it's going to positively or negatively affect your premium. Once this date passes, there's little that you can do to then affect your upcoming renewal. And then of course, the next important date would be when your state rating bureau actually releases that mod and calculates it to you. So that's typically 3 months before renewal. At this point, you can work with your broker then to benchmark and have an idea of what your upcoming renewal rate is going to be. And the last bullet shows what loss information is being reported to the Bureau for a mod calculation. So they are the paid losses plus reserves, which would be the funds that are set aside to pay claims that may have been reported but may not have been paid out yet or paid out fully. And then of course, deducting any recoveries made. So anything that's offsetting the losses or reducing the losses. We're going to talk a little bit more about this in the slides to come because it's really important to see how impactful this can be to the premium. This calculation, this timeline that you see before you really just illustrates what I've just explained. So you'll see that the rating period is going to start 4 months prior to renewal and then exclude, of course, the current policy period that you're in. We've called out the unit stat date in red because, as we mentioned, that's really important to understand, and we really recommend putting that date on your calendar each year so you can make sure everything's kind of lined up before that date passes because of the impact it could have on your premium. So at this point, I'm going to turn things over to Doug. He's going to explain a little bit about the mod in action and talk about some specific examples to help understand.
Thank you, Diana. So before I jump in, I just want to stress to everyone that your mod is extremely important. And the next slide, you're going to really help to bring it all together so you can understand the moving pieces and start putting some tangible actions in place to improve your mod. So for many businesses, workers' compensation is the most expensive insurance line item that a lot of businesses are dealing with. And a lot of people have in their head, businesses as well as insurance brokers, that they say, you might hear the expression comp is comp. The rates are set by the state, so there's not much we can do about it. We just have to take it as it comes. And that nothing could be farther from the truth. So occasionally, you have companies as well as brokers who think the best idea to save money on comp is to just keep shopping the insurance and trying to get more competitive quotes out of different insurance brokers and different insurance carriers, sometimes every single year. There's a lot of downsides to doing that. One, it really destroys your reputation in the marketplace. Two, it takes a lot of time and effort, and time is money. And three, it does not address the mod issues. You're going to see the mod can be significantly impacting your costs, and the mod is promulgated by the state. It has nothing to do with the carrier. So even if you switch carriers, if your mod is high, and I'm going to quantify what that looks like for you soon, that high mod or the penalty associated with that mod is going to follow you with no matter which carrier you went to. So if your mod is 40 to 50% higher than it should be, even if you saved 10% by moving to a new carrier, it's still 40 to 50% higher than you probably should be spending because you did not address that mod. And the reality is, unfortunately, and I'm talking to my industry peers, most insurance brokers and agents do not understand at a very granular level how a mod works, and they definitely do not have the tools and resources to be able to identify what's driving that mod in the wrong direction and to fix it.